Hello everyone. Today I'm going to present a paper which has not been published yet, but it's forthcoming in Critical Finance Review. The title is The Cross-Section of Expected Stock Returns. It's written by Jonathan Lewellen, and this is the version that has been revised up to August 2014. My name is Nancy Du from WSU. And this is presented for our archival seminar in WSU for spring semester 2015. And before we move on to the specific research question, I would like to talk a little bit more about the research background. The whole paper evolves around what's called the Farmer-Macbeth regression in asset pricing in finance, and we'll abbreviate it as FM regression here afterward. So the FM regression has been used to estimate the premium rewarded to a particular risk factor exposure by the market. And typically it's called two-step regression, but here I summarize there are actually three steps. So the first step about the FM regression is we regress for the particular asset. It could be a particular stock. We regress the asset against those risk factors from a time series perspective to determine that the asset's beta for a particular risk factor. So this is a regression running on the time series data. And then the second step, we regress for all those assets, but now we're looking at a particular fixed time period, and we regress those average asset return against expected beta to determine the risk premium for each factor. So now it's cross-sectional data, because now we have the number of equations we have will equal to the number of stocks we have. And this is step 2. In step 3, we will average the coefficient over time for each risk factor, and those coefficients for each factor represent the risk premium given for a unique factor exposure over time. So this is the average risk premium that has been rewarded for a particular factor we have been looking at. And now we move on to the specific research question. So now we know that the FM regression can be used to estimate the premium rewarded to a particular risk factor that has been evaluated by the market. But now what happens is if we have a whole bunch of risk factors and we can combine them to estimate the expected return from the FM regression, and now we're asking how reliable those estimates are derived from the FM regression. So this is the first research question. And the second question, we look at those risk factors identified, and if we plug them in the FM regression to estimate the expected return cross-sectionally across all the stocks, and we want to see how much predictive power they have when we compare those expected returns with those subsequent realized true actual returns. So this is a second research question. Now we move on to research design. This research has been focused on the period from 1964 to 2013. So they use the data from CRISP merged with CompuStat and for this particular period. And also they look at two subsamples. One is called all but tiny stocks, or those market cap larger than 20% percentile in New York Stock Exchange. And the other one is called large stocks. Those are stocks larger than 50% percentile on the New York Stock Exchange. And overall, there are three model specifications of FM regression. And as we talked earlier, the FM regression is all about all those risk factors identified. So the first model includes owning size, book to market ratio, and past 12 months returns. And the second model, we add accruals, stock issuance, profitability, and asset growth. And in the third model, further we include a host of additional characteristics that an investor might have thought that could help to predict returns, for example, dividend yield, beta, and market leverage. So the first test, we look at the monthly forecast expected stock returns derived from 10-year rolling average of FM regression slopes. The figure in the slide shows how the slope on selected characteristics, those are the risk factors identified, change over time. So we can see the magnitude change over time for all those risk factors, but not the sign. If it's positive, it stays on positive. If it's negative, it stays on negative. And also we can see the coefficient, the slope on those selected characteristics decrease over time, which suggests using the past estimate will tend to overestimate the cross-sectional dispersion in true expected returns going forward. That's what we're going to show afterwards. So the second test, we look at the distribution, the mean, and then the standard deviation, as well as the predictive power of those expected stock returns derived from the FM regression. And we're going to see how those forecast expected stock returns line up with the realized stock returns. In terms of the distribution of those expected stock returns, we focus more on the standard deviation, which suggests the dispersion of the estimates. So from the table, you can see all those models suggest considerable cross-sectional variation in expected returns, which has a pretty high standard deviation. And for predictive power, we look at the slope from the regression of subsequent realized stock returns on the forecast expected returns. And from the table, we can see the expected return estimates can explain over 70% of those variation in subsequent realized stock returns, which suggests a high predictive ability of using the FM regression to estimate it and expected stock returns. And there has been additional tests that give some more perspective on how reliable those estimates are deriving from FM regression. So the first additional test, we sort stocks into deciles and compare the spread in expected return between the top decile and then the bottom decile, and then we're going to compare the spreads in expected return with the spread in their realized return and find they are very close. And next, we explore whether results carry over to longer horizons. By longer horizons, we mean 6 months or 12 months, which will be more than 1 month's return. And there are two approaches we can do about this. The first one is we'll just repeat the test using long horizon returns in place of those monthly returns in previous tests. The second approach, we can extrapolate long horizon expected return from those expected monthly return, but impose mean reverting structure. So this we have to estimate it how long, how fast, and those expected return will revert to the mean average return. And the results show using those 6 months and 12 months returns could be quite noisy compared with their monthly counterparts, but still, yeah, they have pretty strong predictive power for subsequent realized returns. And now it comes to the contribution part. There are two major contributions I would like to talk about for this particular study. As we recall, the FM regression has been used to estimate the premium rewarded for a particular risk factor exposure by the market. But now, what's new about this study is they combine all those risk factors and try to use FM regression to estimate the cost of equity capital, or we can call expected stock returns. So use those stock factors in combination, they can estimate the stock returns using the FM regression. And also they find those estimated stock returns derived from FM regression line up pretty well with those true subsequent realized returns. So this is the first major contribution. And also from the practical standpoint, this paper demonstrates to investors how they can develop a composite trading strategy using all the firm-specific characteristics in combination in real time and to forecast stock returns in the future. So this is from the practical standpoint, and those are the two major contributions about this study. And that concludes my presentation. Thank you very much.